Thank you. Thank you for inviting me. Thank you for being here. I'm actually very excited to be here in front of this crowd. I think there's a lot of people here who have an interest in this topic and who I can really benefit from. So I'm very happy to be here. Today we're going to be talking about interest-only mortgages and consumption growth. And we're going to be looking at a Danish mortgage market reform that introduced a new mortgage product, an interest-only mortgage. So just to be clear on what this is a mortgage where for the first 10 years you don't have to make any principal repayments or amortization payments. So you still pay the interest, and we're in Denmark, so we're living in a world where you have full recourse, so the kind of default incentives are different from the US, which is also something that I think you should keep in mind. To be a little bit clear on what we're talking about here, this is a legalization of a new product that occurred in 2003 in Denmark. And to some extent, this is an increase in the availability of these products or the ease of getting it. And I've been talking to some of the Danish people who say that you could get one of these products before if you really wanted to, if you went to the bank and kind of talked to them a lot. But as we can see in the data later, that doesn't appear to have happened that much. You can also think of a situation where you just refinance your mortgage every period, and then in that way you achieve an interest-only mortgage. So I think you need to be a little bit careful about the words here, but saying this is an increase in the availability or ease of access to this kind of product. Now, when we're thinking about this, I have in mind something like a payment shock. So when you go from a standard mortgage to an interest-only mortgage, you can kind of reduce your amortization payments. That's going to be about a 20% decrease in your monthly payments in the first year. And I kind of wanted to think about how would this kind of payment shock affect households. So that's really what we're going to do in this paper. We're going to think a little bit about the cross-section of households and who is affected. Now, in the traditional, I'm going to call it traditional modeling approach in macro housing, you use a leverage-based constraint on borrowing. So essentially you say that we have a value for your house and you can borrow 80% or 90% of that value. And once you start thinking about interest-only mortgages, that framework doesn't really apply. So this is not a shock, not a change that affects value of your collateral or how much you can borrow against it. So we need to have a different framework in mind. And I think it's also instructive to note that if you look at data from the US or from Denmark or from other countries, you see in the US that leverage ratios are actually stable across the period before the Great Recession. So if you want to explain the rise in household debt by relaxed leverage constraint, that seems to be a little bit counterfactual. And leverage ratios in Denmark over this time period actually fall. So we're not kind of living in a world where you have a leverage-based constraint on borrowing. That's really the thing that matters for you. So as Glenn mentioned before, it's always nice to have some theory. And where this paper really took off for me, or my thinking about this, is I saw a presentation by Daniel Greenwald on a model where you have a payment to income constraint. And that's really what this is affecting, right? So you're reducing amortization payments, and you can get lower monthly payments on your mortgage. And Greenwald, Daniel, he argues that this is really the key for understanding the rise in household debt and what happened in the run-up to the Great Recession. And there's another paper by Anna Godeka, who's at the Swedish Riksbank, Swedish Central Bank. And what our paper is going to do is going to kind of think about the empirical parts of this model, and we're going to think about when you introduce one of these products, how is the cross-section of household affected? So who is constrained by their payments and can now increase their borrowing, who's getting relaxed credit borrowing constraints, and who is not. So we're going to explore the cross-sectional impact of the introduction of interest-only mortgages in Denmark in 2003. And to give you a quick preview of the results, we're going to argue that what we see is consistent with a relaxation of payment to income constraints, causing an increase in borrowing. Now, there are two channels here. that you can think of quickly how an interest-only mortgage will affect your consumption. The first is, as you said, the borrowing constraint. So before you could borrow 1 million, now you can borrow 1.2 million because of the lower payments. The other thing that might affect your consumption is keeping your mortgage fixed. Now you have lower savings, right? You have lower amortization payments, which is a form of savings. So you remove those and you shift that into consumption, and that's going to cause that's going to increase your consumption. There's a nice paper by Coco showing a little bit of who takes out this product, where he kind of argues that young people with rising income profiles who really should not be saving, they're the ones who take out what he calls alternative mortgage products. So he's, I think, focusing more on talking about the savings channel. We actually don't find a lot of evidence for that in the data, but I'm going to get back to that later. So instead it looks like this is a payment to income constraint that's getting relaxed, that's causing an increase in borrowing. Okay, so to show you a little bit, and I hope the graph is clear from the back, this is a massive change in the Danish mortgage market. So these mortgages were introduced in 2003, late 2003, and in 2007 it's about 40% of outstanding mortgage debt. So essentially half the population is refinancing to a new mortgage with an interest-only option, which I think is massive. And as you can see also, the debt levels are also increasing a lot over this time. Now, I would like to make one point here. We're not going to talk about this too much, but I want to emphasize that this is not a subprime story. So we're not thinking of a Mian and Sufi type result where you have an increase in credit to low income or low quality borrowers. That's not what seems to be happening here. Instead, you have that, so this is the income distribution divided into deciles, and this is the IO mortgage share on the y-axis, and that says that it's fairly uniform across the income distribution. So about 60% of low-income households use this kind of product, given that they have mortgage debt, of course, but also 60% of really high-income households. So we think that this is kind of relevant for the debate on why household debt increased prior to the Great Recession in the US, where there's been a kind of in my reading at least, an infected debate on between two groups of researchers, where Atif Mian and Amir Sufi argue that you really see a relaxation of credit standards, and it's a credit supply shock, and that's really going towards the subprime borrowers, and that's how we can see that this is a credit supply story. And there's another group of papers that say, if you look at individual level data, we see that mortgage debt is increasing proportionally across the income distribution. Therefore, it can't be a credit supply shock, and it has to be something like house price expectations driving the increase in debt. What we're going to say here is simply that in Denmark, this looks very much like a credit supply shock that just affects the entire income distribution. So we can make a little bit of contribution there to say that just because you see a proportional increase doesn't mean that it's not the case. All right, very briefly on this, interest-only mortgages were introduced on October 1st of 2003. That's when they started selling them. It was a fairly rapid change in the Danish parliament, where they introduced a law proposal in March. They voted in June, and then they started selling these things in October. And what the mortgages does is they allow you to have a 10-year period with no amortization payments. So you still have to repay the mortgage in 30 years. So you don't really extend the maturity as in the model we saw yesterday. Instead, you're kind of just shifting amortization payments forward in the future. And I think this is also important to note that, as far as I can tell from reading the material on the Danish financial crisis and looking at the data and looking at what the mortgage banks say, at least regulatory loan-to-value ratios were unchanged. So you can still borrow 80% of your house. The mortgage banks themselves claim that we had the same credit standards as before. You could maybe argue with that. That's maybe not entirely trustworthy. But the point being that it's not really the same kind of free-for-all situation that you might have in the US. So we're looking at, I would argue, a reform where you should just have a new mortgage product. That's really what we're focusing on. And on the right here, because it's always nice to show a little map, we have a map of Denmark, and we're showing the penetration of interest-only mortgages across Denmark. And even though it's kind of uniform across the income distribution, we see that there is variation across Denmark in the municipalities where this is happening. So you see kind of Copenhagen area here, it's a really high penetration. Along the coast here, where all the fancy houses are, it's a really high penetration, and also in the kind of area around the second biggest city, Aarhus. And if you look at this, if you try to kind of figure out where the variation is coming from, you can you see that it's very strongly related to house values and house value to income. On the municipality level, the correlation between house prices in 2002, post-reform, and IO mortgage share in 2009 is something like 0.86. It's really strong. And the reason why this happens, I think, and we have a little brief theoretical framework to show this, is that the higher your house value to income is, the more likely it is that you are constrained by the mortgage payments. So the idea here is that you're facing two types of constraints. You have a collateral constraint, and you have a payment to income constraint. And in a situation where you have a lot of collateral, so your house is worth $1 billion, in a traditional model you will be able to borrow a lot of money against that collateral, because that's your binding constraint. If you have a payment to income constraint in there as well, the value of the collateral doesn't matter that much to you if you can't afford the payments on the mortgage that you get. So we can show, just putting these two constraints together, that above a certain threshold of house value to income, it's going to be the payments on the mortgage that is binding, not the value of the collateral. So this is getting a little bit at the cross-section of households or individuals here, thinking about who is affected. So we're going to argue that who is affected by this is the people who are constrained by the payments, and those are the individuals who have a high house value to income. All right. So you've already seen some Danish register data these days. I'm not going to talk too much about it because I would like to get into the results. There are a couple of points that I would like to mention though. The first is, well, we have all this income, housing wealth, financial wealth, demographics, all that standard stuff that you have in Denmark. We also have housing transactions, which is going to be important. We have mortgage choice data from 2009, which we have an origination date of the mortgage. So we have the kind of 97% of all mortgages, or 96%. And we have an origination date that we can use to kind of assign back in time to when they got it. That data is subject to some survivorship bias or some sample selection. So in the main part of the empirical analysis, we're not actually going to use that, but we are going to use it later, so keep that in mind. I'm going to take a sample of all individuals between the age of 22 and 75, and I'm going to remove those who trade housing, and I'm going to keep individuals who stay in the panel for the entire period. That is a little bit restrictive, but I want to do that because I want to focus on the households who are not trading houses, because we know from other literature, other studies, that your decision in terms of consumption and savings is different before and after, and I don't really know how to cut that out. So I'm just going to remove. I could also do this on the household levels and to preempt my discussant a little bit, and the results of this. Now, obviously we need a measure of consumption, because that's kind of the main variable that we're looking at. I'm going to use a procedure developed by Martin Browning and Søren Leth Pedersen. I think maybe not developed, but at least they did it first that I know for Danish data. And it's been recently used in an AR paper by Jensen Johansen, where you say that your consumption, or your consumption expenditure, more correctly, is just equal to your disposable income y minus the change in your net wealth. So what you have there is that you have $100,000 of disposable income, and you save $5,000, then your consumption expenditure for that year is going to be 95,000. So there are, I think there are known problems with this measure. There are known concerns. It's going to assign a durable goods purchase of the year to the year that you bought it, in a sense, right? So if you borrowed to buy a car, that's going to show up as a big spike in consumption in that year, even though if you think of a consumption model, you should really think about the utility from that car over a number of years. So this is why we only call it expenditure. We have, on the balance sheet side, we have financial assets, which is stocks, bonds, and cash deposits. We're not going to include housing for a good reason. So what you want to have with this measure is you want to have, there's a distinction between active and passive savings. So what you want to have is the active part. So you want, to use the previous example, you want somebody who actively puts $5,000 of their income into an asset. Now, in this data, there's also going to be another reason why these values change over time, and that's just valuation. So you have a stock portfolio, and then the stock portfolio goes up by 20%, then that's not actually savings, right? It's just the fact that you made some good investments. So we can deal with that in certain ways. They're not going to be entirely perfect, but so in Glenn's terminology, maybe I should raise my hand here a little bit and say that there are some known problems. We can remove everyone who owns stocks from the sample, and that doesn't change anything. We do a procedure where we essentially assume that everyone holds the market portfolio and correct for it in that way. Given that Danish households own like 2 stocks, that's maybe not the perfect measure, but it gets you a little bit. Financial liabilities is divided into mortgage debt and bank debt, and there you have a similar issue that mortgage debt is actually measured at market value, so there's a little bit of, there's going to be measurement error there. And I'm going to try to talk about that a little bit later, and I think we need to do a little bit more work on that, but just to raise my hand and say that that is an issue that you might be concerned with, like this. In terms of thinking about what we're going to do here, our empirical strategy is going to be based on an ex-ante measure of the benefit of choosing an IO mortgage, and that's going to be the house value to income ratio that we saw before. And we're going to measure it in 2002. You could do it in other years as well. We're going to take 2002. So the essence of this strategy is that we have a national reform that's going to affect everyone. And in that sense, we don't have a natural control group, so we want to think of a way to construct that. And this is something that's been done by Mian Sufi and by David Burgers and some co-authors for different types of reforms, but where you have kind of a national policy, it's just going to hit different areas for people differently. This is essentially an intent to treat analysis. So we're going to use housing wealth income ratios in 2002. We're going to estimate cross-sectional regressions of the form like this. So we have consumption in 2000 divided, consumption in a period divided by consumption in 2002. We collapse it to periods to get away from a little bit of the volatility in consumption. So it is a noisy measure. And we do it period by period because that allows the coefficients on all the control variables to change over time. So that's it's essentially a difference in difference framework where you interact all the variables with the period side. So our exposure measure is going to be the house value to income ratio in 2002. We're going to include a number of controls measured pre-reform, so in 2002. And we're just going to clusters down there as some municipalities. Now I'm going to try to show you this in graph form. And this is going to be kind of the main results of the paper in here, so I think we should spend some time on it. Obviously, this is not the main results of the paper. There's going to be stuff on the graph in a little bit. So on the that would be a very boring presentation. On the y-axis here we have year.
The Danish mortgage market after a snowfall.
Yeah, nothing happens. You should be able to publish non-results in economics, and this is my attempt. No. So we have years here, and here we have percentiles of ex-ante treatment. So we have the house value to income ratio in 2002, and we take all the house or individuals and we just divide them into 100 groups. So this is something that I've stolen from somebody else, so I should give credit to David Berger and Eric Zwick and somebody else. But essentially it's a way of showing a difference in difference graph with pre-trends and post-trends for 100 different groups at the same time. And the way we're going to do it is we're going to have a heat map. So the colors is going to indicate the value of consumption growth. So this is after we partial out some stuff, so maybe don't care too much about what the actual numbers are, but it's, yeah, so the color is going to indicate how much did consumption grow for this group in this period, in this year. And obviously with a difference in difference, we want there to be no differences pre-reform. So remember that the reform happened in 2003, late 2003, so I'm just going to say that, well, the action is going to happen in 2004. So we don't really see any differences here. So it doesn't look like there's any differences in pre-trends depending on exposure. Now, obviously, what you want to see is that the people with higher exposure increase their consumption by more. And this is indeed what we see. Hopefully the graph is clear for those of you in the back too. So these guys in our terminology are just more likely to benefit from an IO mortgage. And indeed, they also take up an IO mortgage to a higher extent. Now, it's worth pausing here for a little bit and thinking about alternative stories that could explain these results. So we want to think of, and we're going to deal with that explicitly later, we want to think of most naturally perhaps housing wealth effects, because there's a huge increase in the house prices in this period. We want to think of labor market effects. We want to think of, more on the institutional side, we want to think of later on variable rate mortgage, but we'll get to that a little bit later. Now, if you think about housing wealth effects, I think this is not concrete evidence, but it's suggestive evidence. You would think that that's going to work in the boom, but then it should kind of reverse in the bust, unless there's asymmetries in positive and negative house price shocks. But let's just say that you would expect kind of this pattern here to be positive, and then you would expect a reversal. Same with labor market effects. So unemployment in 2007 is something like 1.5%, and then that increases a lot. So it's a really good time for Denmark, and we should be concerned about that. So thankfully, I guess, for me, we don't really see a big reversal here. So it looks like these effects are just consistent over time. So 2008, 2009, and to some extent 2010 are not really great years for the housing market. It's not really great years for the labor market, but you still see the same effect. All right, you can do this in a difference setup. If you want to, then the results look like this. There's an increase, and then it kind of stays up there. And this is just a year-by-year regression of this. You can do this in a difference framework if you want to as well, but it's going to be very similar results. Right, I have a little bit of time left, so I'm going to try to talk a little bit about robustness checks. I think the results in table form will leave for another day or for a closer reading of the day. But essentially what we do there is we try to get at some of the other things that you might be worried about. We're going to include municipality dummies. We're going to control for the income growth. We're going to remove municipalities with really high house price growth. And every effect kind of stays and is of similar magnitude as before. I also wanted to show this graph because I think this is interesting and it relates to the discussion about leverage constraints versus payment to income constraints. So what we have here is this exposure measure that we have interacted with your leverage ratio in 2002. So we can see that these people here who have low leverage, they have a lot of collateral that they could use to borrow, right? But they don't. So those are the people who are driving these results. So I would argue that this is consistent with payment to income constraint where you have, they're not borrowing in some sense, even though they have a lot of collateral, because they don't want to make the payments, or they can't afford the payments. And really you see that the higher is your leverage, the lower is your responsiveness. So that's some indication that we need to go beyond leverage-based constraints when thinking about a reform on this. Obviously, I've just shown you some coefficients and some colors in the graph. And we really want to think of how important is this? So what's the economic significance of this? We are going to use the bottom 1% group as a control group and then kind of calculate the aggregate effects based on that. And what you get if you do that, you get that the change in consumption is 7.6%. So the result suggests that interest-only mortgages increased consumption by 7.6%. The total increase in consumption for the sample is something like 15%, saying that this is going to explain about half of the increase in consumption over this time period. All right. So obviously you should be concerned about other things going on here as well. We try to do as much as possible in the paper, and let's see if people find that convincing or not. I would start with housing wealth effects because I think that's an obvious choice for why consumption would go up. I would start by noting that results are consistent across low and high growth areas. That's not definitive proof, of course, because even in the low growth areas, house prices did go up. I would also say that using municipality fixed effects is a way of getting away from the average kind of effect of house price growth in the municipality, but it's not enough, I think, because you could plausibly argue that people who have high house value to income ratios are more exposed to house price growth, which would still give you this result. So in the final part, and we do a little bit more on this formally in the paper, I'm just going to argue that if you look at the data, if you look at the evidence on this in Denmark, it doesn't look like housing wealth effects are actually that strong, if you estimate them. So there's a paper by Martin Browning and Søren Leth Pedersen at Copenhagen University and Mette Gertz, who estimate housing wealth effects in Denmark using similar data and using imputed consumption. And what they find is that from the period 1986 to 95, something like that, there is no statistically significant effect of higher house prices on consumption growth in Denmark. If you, they have, I think, one result where there's a coefficient with some stars in it, and that's for one subgroup. I think young people who are liquidity constrained. And if you do this for the period we're talking about here, you only get a positive coefficient on house price growth on consumption in one period, and that's the period when interest-only mortgages are really starting to become more popular. So what we argue there is that it seems more likely to us that it's a common factor driving both house prices and consumption, and that's this mortgage innovation. And indeed, if you remove the households who refinance during this time period, there's a zero coefficient on house price growth. So that's our one way of getting at that. We also think a little bit about labor market shocks, where we say, again, municipality fixed effects is going to control for that to some extent. I also think that the time pattern of this is suggestive. And we can also control explicitly for income growth, and we don't really see that affecting too much. And this final point here is something that I would like to do more on. I haven't done so yet, so you have to give me some time. During this time period, variable rate mortgages also become very popular. They were introduced in '97. They didn't really become that popular, I think, until interest-only mortgages came. But there should still be some formal treatment of these types of products as well. I would say that this is also consistent with a payment to income constraint being relaxed, or households wanting to relax the payment to income constraint. That's another way. Either you change the amortization payments, or you change to a variable interest rate mortgage, which gives you lower payments, or you do both and then you get really low payments. Okay, final 5 minutes. We're going to look at a different identification strategy, where we're going to try to tease out, is the effect coming from higher borrowing at the time that you refinance, or is it coming from kind of lower savings afterwards? And the way we're going to do that is we're going to try to exploit the timing of mortgage choice to estimate these dynamic effects. And we're going to have individual and year fixed effects in there to try to control for, obviously, individual characteristics and some business cycle effects. And we're going to choose the sample of households who themselves take out an IRE mortgage. So this is our attempt to kind of compare apples to apples instead of comparing an IRE mortgage holder with somebody who has a fixed rate mortgage. That's something that I don't think you do and I want to do, and I think John referenced this later, yesterday, where he said people with ARMs are different from people with firms. So we don't want to compare this. So we're going to use only the sample of households who choose an IRE. And this is a little bit what it looks like. So mortgage goes up, mortgage spikes. So the dependent variable here is consumption to income, so to get away from income effects, and to relate this to kind of the fraction of your income that you consume. Now, this is where maybe the mortgage data also becomes a little bit more problematic, that you have a valuation effect there when you refinance. Again, I think I need to do a little bit more on just really getting at, is this cash out refinancing or not? I would note that if you look at the mortgage interest payments, they also spike at the same time. So if you think this is just something going on that you refinance to a lower interest rate and that raises the value of your mortgage, I think you should see that the mortgage payments actually go down as well. But again, raising my arm and saying we need to do more. If you look at consumption, you see that there's a big spike at the time when you refinance, and then actually little going on here. And I'm not going to show you this result, but I've also done this where you compare it to people with a fixed rate mortgage, and then you get a little bit of a different dynamic going on, where it looks like IO mortgage holders are actually consuming more than they did before. But I think that's some evidence of the selection problem here. So we want to compare like to. Finally, we do a little bit of heterogeneity analysis in this, and this is maybe a little bit difficult to see, but we have house value to income, and we have the year of refinancing. We have 3 different variables: mortgage, consumption, and assets. And what I would note is, so this is the year of refinancing interacted with a dummy equal to 1 if the house value to income ratio is high, essentially, or above the mean. So what happens in that case is that you extract more equity, you increase your consumption by more, and it looks like you're saving a little bit less post-refinancing. So here we've collapsed it to, this is year 0 and this is all the years afterwards. On the other hand, we see that for young households, or rather, let's say, old households, which will be this coefficient here, it looks like they're actually consuming a little bit more relative to their income compared to what they did before. So there's some kind of evidence saying that, or some idea here is that if you're old, if you're above retirement age, and you have a mortgage, maybe you don't really want to pay that down anymore. You want to live off the savings. And that's a little bit of evidence to say. 1 minute left, so this went far better than I thought, at least in terms of the timing. Our conclusion is going to say, first off, we think this is an interesting credit supply shock that you can really only understand by thinking about payment to income constraints. And what we're going to show is that it's going to affect it did affect a large part of the population. The impact is not uniform. I'm going to make a little claim here that maybe somebody who knows that paper can help me figure out, but there's a paper forthcoming in QJ that argues that the refinancing channel of monetary policy depends on the level of equity in the cross-section, so that areas with a lot of equity, they seem to respond stronger to interest rate changes. So I would say that areas with a lot of equity might be areas where payment to income constraints are more binding, which would make sense. That's not really their story, but I think it will be an alternative way of thinking about it. Again, this is something that we had before. I would like to end, now the timer is up, but just to end on saying that I think it's important to also have a discussion about the normative implications, and I didn't add this just after Glenn talked a little bit about it, but I think you need to think a little bit, or it's difficult to think of, is this a good thing or not, on the part of households. So you can think of a story where somebody is credit constrained and you're relaxing their credit constraints and they can achieve a high level of consumption closer to what they actually would like to have. In that case, that's probably a good thing. You can also think of stories where you had some kind of preference thing or something that hyperbolic discounting you just really like, or you're financially literate, something like that. That just means that you take out this mortgage and you don't really realize that in the end you're going to have to pay a lot more. And I would also note at the end that if we're thinking about this, we also need to think a little bit about the externalities of pretty much of introducing this kind of thing, so changing the mortgage market. And I realize I'm out of time, but I think that's very important to state, that I think this effect is coming from the fact that you introduced this product, not the fact that you had this product. So you want to think a little bit about what are the externalities of changing the mortgage market design. And with that said, I would like to thank you for listening, and I look forward to hearing your comments.
Well, thank you, Claes, for a very nice presentation and a nice paper. So I'm going to start with a little summary, but I think most of the people must have gotten this. So your setting is a legal authorization of IO mortgages in Denmark, and you show that there's a big spike of IO mortgages after this legalization. And your research objective is to measure the impact of IO mortgages on consumption expenditures, and I'm happy that you emphasize that during your presentation, because as you have this big spike in consumption at one point in your paper, it suggests something like consumption expenditures more than consumption flows. And to a lesser extent also you look at portfolio diversification. I mean, you discuss more this in the introduction and then in the result, but I think it's a fair point you mentioned, because an IO mortgage, as you don't have to accumulate home equity at the beginning of the period, you could diversify better by accumulating other assets. So that's also a thing that you could look at more deeply in the paper, because I think that's an interesting adding. So the identification is based on the assumption that those with a high ratio of housing over income are more affected by the change of the regulation because of a payment to income constraint. So if you have payment to income constraint, and I'm going to come back later on this H over Y is going to be linked to the effect of the policy change. So your main finding is a strong effect of IO mortgages on consumption expenditures, and you also look at the pattern of consumption around refinancing for those who take the IO mortgage. And you find that the increase is concentrated around the year of refinancing. I'm going to come back also. So overall, I really enjoyed reading the paper. I mean, that was a nice, I think the research question is interesting and of importance, both from a macroeconomic perspective, because the effects that you measure are quite high, I mean, in terms of increasing consumption. So I think from an aggregate consumption perspective and a macro perspective, that's an interesting point. And with respect to household finance, that's interesting as well, because one advantage of this IO mortgage is that if you have rising income profiles, you don't want to accumulate home equity very early, so you may benefit from this kind of mortgage. So trying to understand how people use this kind of mortgage products is actually something that I think is interesting. I found the econometrics overall well done, though I'm not a reduced form econometrician, more structural guy. With extensive robustness check, and you study various interesting features of this great database that you have. I mean, Denmark has been mentioned a lot for a very great database, so I'm not going to come back to that. So my main comment, my first one is actually, so you don't present the conceptual framework that leads you to your identification strategy, but typically it rests on two constraints. So the first one is a loan-to-value constraint, which says that the maximum you can borrow is just a share of the value of your home. And so you can split the value of your home between just the price and the size of your home, or also a measure of quality of the house or locations. And then you have a second constraint which can apply, so you think these both constraints apply to borrowers, which is a payment to income constraint, which is just says that your mortgage repayment should not exceed a share theta I y of your income. So, and here the gamma is the amortization rate, and RM is just the interest mortgage that you get. So, and what you argue is that the payment to income constraint will be the one binding if actually you have the MLTV, so the constraint imposed by the loan-to-value constraint, which is higher than the one imposed by the payment to income constraint. And so then you end up with this expression which says that, well, you have H over Y, which is our housing value over income, times gamma plus RM, which should be greater than this, and this is when this kind of condition is going to lie. So what this tells you is that those who are initially constrained by the loan-to-income constraint will be more sensible to a change in amortization. So typically, when you have this policy change, this affects this gamma here, and it will also these people will be more sensible to change in mortgage interest rates. The larger their home relative to their income is, if they're facing this binding constraint. Also, they will be more sensible to changes in house prices because you will have this playing as well. And also, they will be more sensible to changes in their income a priori. So you should have all this going on at the same time. So when you do when you work on your main specification, typically it's similar in spirit to this kind of regression where you look at consumption growth and you say, well, it's a function of some XIT which interact with the housing over income ratio in 2002, and then a set of controls. And in your baseline specification, typically what your XIT is a dummy which is equal to 1 if you're after 2003 and to 0 if you're before 2003. So that's mainly what you do. So in the last version of the paper you got, you did a version where you have this house price growth here, which is to get rid of potentially housing wealth effects. But actually, based on your conceptual framework, I would have liked to see a regression of this type with this whole set of regressors. Typically, because you control at some point for the change in interest rates. But the thing is that, according to your model, these guys who have a large H over Y should be more sensible also to changes in interest rates. So you would think that if this guy have a high H over Y, they get a very low interest rate going down, then they should increase their consumption more than the guy who have a low H over Y. So you should, I think that would be interesting to have this, and also possibly to have income because it's going to change the thingy. So that's my first comment. My second comment is, so I had some difficulty reconciling the results in section 6, which is this graph that you showed before, which is that after the reform, consumption growth, which is a ratio of the consumption, for instance, in 2005 over the one in 2002. So you find this strong increase in consumption. But I had difficulty linking this to what you got in section 7, which is how consumption evolves around the time of refinancing. Because when I see this graph, it looks like, well, there is a persistent effect. I mean, you could say, okay, these are just averages, so that's fine, but then you get this heat map. And this heat map tells you that, well, it looks like it's not driven by one or two guys. It looks like there are many guys who actually have increased their consumption during many years, but here, just a spike in 1 year. So that's, for me, that was quite puzzling because I couldn't figure out how this would relate to that. So so I would like to have additional explanations on what could explain these differences. Also, you use a different left-hand side variable, so I don't know if this linked to this, because here it's consumption over income. Here it's consumption over consumption in 2002, so this is a different left-hand side variable, and I didn't understand why you had to choose a different one at this point in time, so I would like to have some more details about this point in data. Also, here you have the mortgage debt to disposable income, so I was quite surprised by this figure. The magnitude of the coefficient, I'm not able really to interpret them, but I would have thought that this guy is getting an IO mortgage. He would have, so their disposable income can grow fast, and you can have this steep decline. But if their income is not growing really fast, you would expect some straight line here, because they don't have to repay the mortgages after 10 years. So you would expect that this mortgage, the value of their mortgage, would be more or less flat. So these are my main comments, and I have just a smaller one. So as you mentioned, you present results at the individual level. I would have actually preferred some results at the household level, but you told me some people told you to do this at the individual level. But I think this is a household problem, so for me this is more the household level. And also in your treat, you say it's robust, so I would like to see in an appendix at least the results for the household. That would be interesting. Also, I think for the individual level, it might affect a bit the magnitude of the effects you measure on how you split the mortgage, because now you split it into two. If you observe the mortgage twice in your data, you just say, okay, I have 2%, I split the mortgage into two, but I think actually the split should be linked to income of the respective members of the household, because if you have one of the members earning much more than the other, then you know that this is the one mostly repaying the mortgage proportionally. So I think that would be maybe more interesting to do it that way in the future. Also, I would have liked some more discussion on the differences between the sample used and the excluded household, because you could think that higher mortgages are good, especially for young borrowers, but then you kind of exclude them because, they are not the guy refinancing, they are the guy getting new mortgages. So you get rid of these guys. So I would like at least to have some demographic differences to see which guy you are not looking at here. So I understand perfectly that you don't want to have this because it gets trickier to identify, but I would still like to have some difference, because you exclude a lot of people, at least some people that way, which might be of interest for policy related to our mortgages. Then something very puzzling, so I'm working mostly on retirement issues, so that was something I mortgage for retirees. So you have this IO share among 55 plus, which is much higher than, among people who get mortgages, the share among retirees is a lot of people that get an IO mortgage, which is quite surprising, because you have this, and it goes far, to the age of the people. So it's not only 55 plus, this is 65, 75 people who get actually mortgages with IO. So I would like a discussion about the reverse mortgage market in Denmark, whether it exists or not, and also what these people do afterwards, after the 10 years. Well, you have 10 years in which you don't repay your mortgage, but then you have to repay it, and your income is not going to grow, you're retired. So there's something interesting going on there, and I would like to, I was really puzzled by that, and I would like to see what's going on. And the last one is just I found the terminology of IO borrowing, I got it, but the lower savings, sometimes in some parts it was kind of confusing, because this is just you delay the accumulation of home equity conditional on borrowing a certain amount. And someone, as you mentioned, other types of savings, that was kind of, that could be misleading at some point, but it's really a minor comment. So, overall, thank you very much, and it was a really nice paper to read.
Thank you.
Did you want to take questions from the audience?
I can respond very quickly. Thank you for the discussions. I think I should do all those things. I agree with I think everything you said. I think that the graph with the aggregate results and individual results is actually very interesting. Why that happens. So if you look in the data, the increase in consumption really comes from kind of an increasing share of households who refinance in any given year. So if you take it on the individual level, it looks like this. When you refinance, you borrow, you increase your debt at that year. If you aggregate that up to everyone in each bin, some of them are going to be refinancing, and some of them are not going to be refinancing. So the people who are refinancing are the ones who are going to increase the consumption in that bid. I don't know if that makes sense, but
No, but so it's across all your bins, you have this going on.
yeah. So if you look at the data, it looks like the increase in consumption in Denmark over this time period is really, at least in the expenditure data that we have now, is really driven by kind of a higher fraction of households refinancing and then refinancing, taking out more equity.
And so it's quite random across the housing over income distribution, your refinancing side.
No, it's
I mean, it looks like,
so it's just going to be a higher proportion in each bin that is refinancing each year.
yeah, but I mean, it's you don't have like, for instance, those with IH over Y refinancing in 2004 mostly, and then those with lower refinancing later. It's more or less kind of equal.
Yeah, I think that's a fair thing to say, yes. But thank you for the comments. I'll get back to that. Maybe there are some questions.
Yeah, sorry, I have two questions in fact. We have some of these IOs in Switzerland as well, in certain tranche of the entire mortgage. And the reasons are tax break. So because you are taxed on net housing wealth, you don't want to repay too fast the mortgage. So here you're sort of slowing down the growth in net housing wealth by freezing the repayment. So I was wondering if some of the effect would come through this tax break rather than relaxing the budget constraint. Maybe it's not the case that it is taxed
No, there is a mortgage interest deduction, and I think it's valuable for tax reasons to keep your debt levels high if you want some tax shield or something like that. I haven't thought about whether that can explain some of the results, but I think that's a good point to look into. At least there is a mortgage interest deduction in Denmark, and high debt levels is good if you want to take advantage of that.
My question is linked to what was saying, which is at some point you're going to have to repay more if you don't do it now. So would you want to consider also the consumption growth over a longer horizon to see if you're going to really dampen consumption growth after the 10-year period in which you sort of repay?
Absolutely, and I think this would be a new product would be to look at what happens when the 10-year period runs out, and I think that will be very interesting to do. I know from talking to some people at the mortgage banks and from KU, it seems like a lot of people actually refinance in 2007-8 to this, and in that case there's going to be, or later on, and in that case the main chunk of this is going to come in 2019. It might be a future product, but I think that would be interesting. I know anecdotally from the guy who gave me the data on mortgage choice that he said that a lot of people actually refinance the new interest on the mortgage. I think we have yesterday.
Yeah, I have actually a couple of comments. The point is we have a very related paper using more or less the same data, but also actually going back before 3, so we can even cover the introduction and do different ifs and stuff like that. But a couple of things, and what we do basically is your last conclusion slide. I mean, actually the big question, so what are the pros and the advantages and disadvantages of IOs that we got? But I thought of a couple of things. You said income growth was insignificant. Was that?
No, it didn't change the results.
No, so I mean the COCO story, right? The COCO story that future income, those that take IO mortgages are primarily those with a high future income growth. That we actually also find, but particularly among the young actually, where you expect income growth to be high. So that. And then I thought, have you checked annual consumption growth rates? Because I mean, it turns out that they are very volatile after the crisis due to the stock market fluctuations.
So I've done year-over-year changes in this, which is a lot noisier. It gives you, I think, similar results, but I kind of like this aggregating into different periods because you get away from a little bit of that just variation over time. So using year-over-year changes, I think, is that jumps around a lot. I haven't looked at that for a while, but as far as I remember, it gave similar results, but they're a little bit more. A little bit more.
And last comment is, I mean, also following up on the discussion, is the particularly interesting actually what happens to the old people, and we think that's really it's quite. So maybe I've looked at that and we think that that's quite interesting. We look at that. So whether you've looked at that, so the age dispersion or the age differences and so on, which we find quite large differences from middle-aged and young and old-aged and so on. Particularly the young, the old, they use it to get rid of a liquidity constraint and stuff like that. But yeah,
So I have done that, and I've done similar to the leverage heterogeneity based on leverage. I've done heterogeneity based on age, and it's increasing in age.
Yeah, exactly.
So that's in the paper. I didn't show how, but it's in there.
And just to the discussion, I mean, I come from Denmark and so on, right? It really is so, I mean, particularly for the old, when the 10-year period runs out, it just takes a new 10 years.
Okay, so you can get to that another one.
You just get, if
Okay.
the loan to income, if the loan to value is still below the 80%, you can just refinance and just take a new IO mortgage 10 years and new IO mortgage 10 years.
Thank you very much.
So
I'm interested if anybody knows whether reverse mortgages exist at all in Denmark?
No. No.
Okay, so then this is the best approximation. I mean,
Yeah.
reverse mortgage is negatively amortizing.
Yes.
yeah.
And an IO mortgage which you just keep refinancing is zero amortizing.
And that's
maybe
why
what older people really want is a negatively amortizing mortgage.
exactly,
Which
that's
is
why we find it
IO
interesting for the old.
Yeah.
And that's also what we find a little bit in the heterogeneity at the end, that it seems like old households are using this to increase their consumption level after also the fact. And I think that makes sense from a life cycle perspective. Why you should, unless you have strong bequest motives, I don't know why you should pay down your debt when you really want to live off your savings.